Hi, everyone. Welcome back to the Harbinger VC podcast. Today, we have joining us Edmond Ng, who is a founding partner at Axiom Asia, one of the top performing private equity fund of funds that invests across venture, growth equity, and buyouts in the greater Asia region. Axiom has had a stellar run since 2006, recently closing $1.8 billion for their Fund 6, managing about $7 billion in total, so they're well capitalized to continue backing growth in the region. Edmond shares with us his formative experiences, including what it was like to join GIC at the height of the Asian financial crisis in 1997 and lessons learned. Edmond describes the founding of Axiom Asia, what it took to survive in the early days, and some of Axiom's best investment decisions. At the same time, Edmond discusses challenges and tough decisions that fund of funds must make with regards to their managers, as well as the differences in private equity investments across stage and region. Finally, we cover some of the shifting market dynamics in China, from key technological and commercial trends to financial liberalization and the role of the Chinese stock exchanges on future investments in the market.
Hi, Edmond. Thanks so much for joining us today. As is customary on our show, before we dive into the details of your storied career as an investor, as someone who's experienced really firsthand the Asia financial crisis in the 1990s, the early innings of the Chinese economic growth in the 2000s, and through a lot of the internet and technology-driven boom this past decade, which have resulted in very large companies. So $100 billion companies like Xiaomi or Kuaishou in China, to Shopees and the Grabs and Gojeks in Southeast Asia. Could you start by telling us a bit more about yourself, where you're from, and what are some of your formative experiences before we jump in?
Sure. So I was born in Hong Kong when it was still a British colony. Both my parents moved to Hong Kong in the 1950s from Shanghai. My grandparents were from the Jiangsu province and also northern China. So from a very young age, I learned to understand Mandarin, Shanghainese, and Cantonese. Although Cantonese was the only dialect that I could speak as a kid. I picked up Mandarin only after I met my wife when I was a junior in college. I can still order food in Shanghainese. So in the 70s and the 80s, the Hong Kong economy, as one of the four Asian tigers, was flying at the time. My parents were business owners and really benefited from this trend. Since a young age, I got to travel a lot to different places in Asia and also North America. Recently, a Taiwanese businessman asked me how best to describe Hong Kong. My answer was actually one that I learned from my social studies class in elementary school. And that is, Hong Kong is an entrepot. And to me, it's not just an entrepot for goods, but also for people. Many of my parents' friends had the goal of moving to another country. Usually it's Australia, Canada, and the US. So Hong Kong people are always looking for better opportunities, which makes the place has, a kind of dynamism that you could not find anywhere else. It was truly a city that never slept. People moved there from mainland China to look for better opportunities, and then they moved to the West for even better opportunities. So I first visited the US when I was 6 years old. We went to see some of our relatives and friends in Los Angeles and San Francisco. Yeah, I think I fell in love with the place right away. It was hard for a kid not to like all the space that you get in the US. Most people in Hong Kong, even the decently wealthy ones, still lived in apartments. It seemed, everyone in the US lived in big houses. And I made it my goal to study in the US one day. So when I was 11, my father had to move to Taiwan for work. At the time, I was enrolled at a very good public school in Hong Kong. So I decided to stay in Hong Kong with my grandmother to finish my junior high studies. Eventually, I went to the US as a 10th grader in a boarding school in Los Angeles. And funny enough, after 3 years in Claremont, California, I was convinced that I could not lead a suburban lifestyle, and I needed to get back to a city. So I applied to really just colleges in big cities like New York, Chicago, and Los Angeles downtown.
Mm-hmm.
So I was fortunate enough to get accepted by Columbia in New York, which I believed at the time to be the greatest city in the world. Just quoting from Hamilton the musical. And it was also at Columbia that I decided to pursue a career in finance.
Mm-hmm.
So when I first went to Columbia, I thought I would study civil engineering, because I liked physics a lot, and I like building bridges, idea of building bridges and other infrastructure. But I had to give up that idea because I had I still do have a pretty severe allergic reaction to dust and dirt. So visiting construction sites just wasn't a good idea for me. And then while at Columbia, quite a lot of my friends were talking about going into finance, I guess being in New York and all. And then, cities in cities like New York and Hong Kong, are very expensive. I think it was just natural for people to think about getting a job that can pay for their college tuition and also cover their cost of living. So I ended up majoring in industrial engineering, which was the closest thing to finance that the engineering school at Columbia offered. And I subsequently went to Stanford to get a master's degree in a major called engineering economic system. I think the department has changed its name to management science and economics now. Oh, sorry, it's management science and engineering. So during, I guess, my final year at Columbia and my time at Stanford, I started reading books about the finance industry. Some were recommendations from friends, and some were just just random reading. And I read books like Reminiscence of a Stock Operator, Liar's Poker, Fiasco, among others. But the one that I found most interesting was Barbarians at the Gate.
Yep, great book.
So
classic.
So I've always been a fan of war histories, and the image of a bunch of barbarians laying siege to cities really appealed to me. And then private equity, became the subsector in finance that I wanted to join the most. And fortunately for me, the Government of Singapore Investment Corporation, GIC, just happened to be recruiting from Stanford for its alternative investment divisions. And GIC already at the time had a global investment program with offices in Singapore, Hong Kong, Tokyo, San Francisco, London, and also Frankfurt. I also really wanted to see how Singapore was like. As you know, there had always been this rivalry between Hong Kong and Singapore. Right. And I just thought it was good to see, what the rival looked like. So it was the perfect opportunity for me. And so I accepted that offer and went to Singapore, and that was in 1997.
It's a lot of stuff happened that year, right? Isn't that when the financial crisis began there in the region?
Yes. 1997 was truly an eventful year, and particularly for a Hong Kong person, right? Because that's the year when Hong Kong ceased to be a British colony. The handover ceremony was on July 1st of 1997, which coincided with the day I started at GIC. So I didn't get to watch the handover ceremony on TV.
Wow, yeah. What timing?
And of course, the next day, July 2nd, the Thai government decided to abandon their currency peg to the US dollar, and the Asian financial crisis officially began. I think I look back and I think I've always just been a very lucky person. And just great, working for a company with such a deep pocket. The crisis definitely hit the performance of GIC at the time, right?
Mm-hmm.
But GIC has such a large program. It was at the time still underinvested. So the Asian financial crisis actually presented a great investment opportunity for us. However, it was actually very hard to do deals. Most of the good assets in Southeast Asia, were owned by big Southeast Asian families, and they were all tough negotiators. Looking back, I would say, I was probably too conservative in pricing some of these assets, and then now I learned the lessons. Insisting, on buying, companies at historical average valuation multiple is probably not a good strategy, because both the revenues and the earnings of those businesses, were way down. So yeah, we need to be mindful of that. And then some of the other lessons I learned was that debt could be a great friend when things are going well, but it could also really kill a business when it is on the way down. I think to this day, I'm still adverse to using too much debt in our investments and also in my personal finance. Another lessons would be, in many emerging markets, enforcing minority shareholders' rights or debt holders' rights could be very difficult. And then also, some of the most successful businessmen in the region, they turn out to be some of the most unscrupulous ones as well. Can't name names, but definitely there were a lot of people not honoring their contracts at the time. And it's not just the businessmen, even the governments. Even the governments can, even government contracts could be voided. And I think to this day, I don't like businesses that rely too much on government businesses.
Got it.
Just a very different world in the emerging markets. It's not like in the more developed markets in the US and also Western Europe.
It's fascinating to hear that. Over the past couple of decades, what do you feel has changed?
So the Asian financial crisis mainly just hit Southeast Asia and also Korea as well, right? So I can't really say how the system has changed since then, because I think it just hasn't, the system just hasn't been tested again, right? When we talk about global financial crisis, it seems like it's, it actually didn't hit Asia that hard. China had been on a rise since 1997. And I think much of the regional economy was more dependent on the growth of China. And China did very well during the global financial crisis. So the system hasn't been tested. So I don't know. I think for China has actually become a lot more sophisticated. My time at GIC is, we've always been able to exercise our minority shareholders' rights. Maybe it just take a little bit more time to do things. It's just like, for example, redemption rights. If your counterparty doesn't have money, they just don't have money, right? So you just have to wait for them to find that money to to redeem your investment.
Mm-hmm.
But it's really, I mean, our operating, I think GIC's operating experience in mainland China had been very good. And I think that carries over to Axiom Asia as well. So we really haven't had any problems.
Right.
Mm-hmm.
Okay. Well, we'll see how things develop.
Mm-hmm.
Getting back to some of what you're sharing, I'd like to get to Axiom Asia, which is the fund that you founded with a few other partners in a little bit, and also spend more time on China, kind of what's going on market and things like that. But mentioned GIC, and GIC is a highly reputable investor, and they're a very comprehensive investor and quite large. So just wondering, like, since you started with them back in 1997 till today, what are some of the major changes, or has GIC evolved in any way since that time?
Mm-hmm. I'm really glad that I started my career at GIC. And maybe because the pay there wasn't very good. So people were just much nicer, and they were very helpful to junior members. Right. So and also with GIC, with the global presence, I got to work in Singapore, the San Francisco Bay Area, Hong Kong, and also Beijing. Also worked for many bosses. Built a lot of great friendship there. And by and large, I got along with all my coworkers and bosses extremely well. And at the time, I got to meet a lot of top private equity players as well, and get to learn from the successes and mistakes over the year. So that was just a good experience all around. GIC doesn't really like its former employees to say too much about it.
Okay.
But I think it's safe for me to say that GIC is really one of the oldest and most established institutional investor in the private equity market globally. It started committing to private equity and VC funds in the early 80s. And was among the early investors in KKR and Sequoia funds. It also had a long history of doing co-investments. Right? I think some of the, most famous Silicon Valley companies were actually backed by, well, I wouldn't say completely backed by GIC, but GIC was investors in some of these Silicon Valley names early on. So to be able to work at such an organization is a really I just felt really privileged. It is truly an amazing organization, just like the people who had the foresight to start it in the first place.
Yep.
And these people, and they were really the founding fathers of Singapore, the country. They also determined that right at the start that GIC could afford to take a very long-term view in making investments, which was why they could start investing in private equity funds and venture capital funds. So the changes after I left is I don't know, like during my time, GIC just kept growing, and after I left, it became even bigger. I think the deployment pace of the GIC private equity program now is probably more than 10 times the size. When I was still an employee in 2005.
Yeah.
And I would say the biggest change at GIC since I left would be its stance on publicity. When I was an employee there, one of the key negotiation points was anonymity. Like we go out of the way to make sure that the GIC name would not be mentioned in any media. So we would basically have this clause with our fund manager saying that you cannot you cannot tell people that GIC has invested in you. Same with the portfolio companies. You cannot use the GIC name to, in any media release. But now, you see GIC's name all over the place. That's a really, really big change. And I think it's important because it makes it easier for GIC to do deals.
Yes. Yes.
So I think it's a great change. And as a former employee, I just feel very proud to see GIC everywhere, and also getting more respect.
Yeah. Certainly. Again, as I mentioned, GIC has a sterling reputation, and it's really interesting to get your kind of insider's perspective on what it was like working there through the years. Did not realize that they were some of the, I guess, major early backers of those, KKR, Sequoia, and it seems like they laid the groundwork for more co-investments and kind of finding different ways to kind of increase returns to the LPs. So that's very interesting. Singapore is just the incredible example of nation building and seemingly kind of continuous excellence of investments too. So thanks for sharing that with us. So it'd be good to get to the fund that you founded, which is Axiom Asia. Before we kind of talk through some of the investment work that you've done there, could you first share a bit more about what was the origin of the fund? Like, who were the key other partners that you worked with? What was the initial thought process? How did you try to formulate the initial investment strategy?
Yes. So, yeah, I guess after 7 years at GIC, I was getting a little bit bored, and I've always wanted to have an entrepreneurial experience. So in the middle of 2004, so I remember it's July 2004, I tendered my resignation. But GIC asked me to stay on until they could find someone to replace me. So I actually, after tendering my resignation, I stayed at GIC for 7 more months. Actually during that 7 months, the different people within the GIC, different people from different departments of GIC started approaching me and asked me if I would like to join their department or move to another office. I was based in Beijing at the time, so it was natural for Singaporeans to feel that Edmond must really, really want to go back to Singapore. And then of course then the US offices called me as well. But anyway, I made up my mind to leave. So right pretty soon after I left GIC, 2 of my former bosses at GIC approached me. And they were still employees at GIC at the time, and they have separately tried to convince me to join their division. So they say, it's like, and they basically came to me and say, "Hey, Edmond, we are thinking about setting up an Asia-focused private equity fund of funds. Would you like to join us?" And it's I've always liked the fund of fund business because I forgot the year, but in 1999 or 2000, I was tasked by my boss in North America at the time to look into the fund of fund space. So I basically evaluated all the fund of funds, active in the US at that time. The likes of HarborVest, Adams Street, and I think HarborVest. Oh, sorry, I mentioned HarborVest already, but Horsley Bridge, and a few others. And I thought it was just a brilliant business idea. So when these 2 gentlemen came to me, I was like, sure, let's do this, right? And of course, they were still at GIC, so I was really the only person who could do a lot of the grunt work. That's how I got involved into the founding of Axiom Asia. And then, of course, Axiom Asia was only formally set up in early 2006.
Got it. Okay, and when you set it up, so this is like 2005, 2006 period. You're setting up a fund of fund. It's Asia focused. How did you think through what stage of private equity investment to focus on, and what are some of the key markets? How did you figure that out?
Yes. I was the more junior member of the three founders, and one of the reasons why they got me involved was because I was in the Beijing office, so I know China extremely well, and they knew China was going to be an important market for this Asia-focused fund of funds. So I don't want to claim I don't want to claim credit. So it's really their idea that there would be this demand for Asia-focused fund of funds at the time.
Yep.
So I think in hindsight, that was the best time to start this business. The US and Western European markets were very, very hot. Institutional investors were seeing record distributions from the investments in PE funds in those markets. And they were running out of places to put their money. Valuations in the West for private equity deals were hitting historical high. So Asia just looked like a good place to put money. And I think after the Asian financial crisis, some of the US and European buyout firms, they set out outposts to take advantage of cheaper valuations in the market, post the Asian financial crisis. And they were, around 2005, 2006, that's when they started to see real returns and real distributions back. So that got institutional investors in the West more interested in Asia as well. What can I also say? And Asia was doing well in general, in terms of economic growth, right? So, China joined WTO in 2001, and then started growing at an extremely fast pace, and the demand coming out from China, was driving growth in other Asian countries as well. And it's not just the other emerging economies, right? It was also the mature economies. I think Australia, Japan, South Korea all benefited from the growth of China. So coupled with investors starting seeing real returns coming out from Asia private equity, people just want to invest in Asia. But then of course, I think the Western institutional investors, they realized that the cultures in Asia could be quite different from that in the West. And this coupled with the language barrier made investing in Asia on their own seem like a very dangerous proposition. So the Western institutions, they were looking for some local guides to help them build their program here.
Makes sense.
And then GIC was already very well known in the LP circle in the West. So I think a group of investment professional coming out from GIC seems like a very safe bet for them. And we managed to raise a $440 million fund.
This was in 2006, right?
This is in 2006. The final closing was in 2007. And we weren't the only people who saw this opportunity. So if you, I'm sure, so we did a study once. So from 2005 to 2007, there were more than 30 Asia-focused private equity fund of funds formed.
Wow, okay.
So competition for us was pretty fierce. And there was no guarantee that we could raise a second fund, let alone, 6 funds. So to make matters worse, the fund of funds business model was actually being challenged in the West by gatekeepers like Hamilton Lane and Stepstone. So these firms, Hamilton Lane and Stepstones, they are really in the separate account business, right? And in a separate account, typically the investors pay a much lower fee than what they would have to pay for fund of fund, for fund of fund managers. So I would say we were fighting for our survival, and actually many of our old colleagues from GIC do not think we could survive. So for me, Axiom Asia was definitely an entrepreneurial experience. Besides looking after our investments in China, I was also the COO and CFO of the firm. And there was really no money for the founders in the business for our first 6 years of operation.
So my initial thought was, Axiom Asia has been very successful. And I thought, the entry point in 2005, 2006 was probably fairly good. It seems early. It was before the mobile internet boom in China, for example, and some other mega trends. And I thought that Axiom Asia, benefited greatly from entering early, working hard, doing some good deals, and clearly being quite successful as a fund of funds. But what you said earlier was, it was very difficult in the early days, and it was very competitive with many other fund of funds being launched around the same time frame. So I guess the simple question for you is, what did it take to differentiate against some of these other fund of funds? What did it take for you to both survive, succeed, and continue to raise large amounts of capital from your LPs? So a lot of stuff to talk through there.
So maybe differentiator for Axiom Asia. We were probably the only truly all Asian outfit. Most of our competitors at the time, they were outposts set up by other fund of fund managers in the US and Europe. And maybe we just understood the market a little bit better than they do. So we got our strategy right. And so I think that's really a key differentiator. And then all the partners, right? All the decision makers at Axiom Asia live in Asia, right? We don't have an investment committee sitting in the US or the UK or in Switzerland. So it made us react faster to, I guess, changes in the market. So I think that's really the key differentiator. And I talked about, so you also earlier asked about, our investment strategy and focus. So it could be a little bit, I think that sets it apart as well. So there are also some fund of fund managers that are emerging market fund of funds, right? So we never marketed ourselves as an emerging market fund of funds, right? We made it very clear to our investors that we are an Asia focused fund of funds, right? So we would invest in both the emerging markets in Asia and also the mature markets in Asia. And we weren't just going to do buyout funds, right? We are going to invest in buyout funds, growth equity funds, and venture capital funds.
Yeah.
And I think depending on where the institutional investors come from, they react very differently to this strategy. I think a lot of the Europeans, because back then the venture capital funds in Europe didn't produce good returns. So they were very averse to venture capital. Right. So when you tell them that you're going to have significant venture capital exposure, they'll just say no. No, thank you.
Okay.
No.
Interesting. Yeah.
But that was the wrong thing to do. So I think a lot of our peers, they started out putting a lot of money in buyout funds. And I guess buyout returns from Asia just wasn't that great. So it made it difficult overall, especially in that period because of the global financial crisis. Right. So the major, if you think about it, actually the biggest buyout market in Asia at the time was Australia.
Okay.
And now looking back, the Australian investments made during that period, they didn't do too poorly, but it took them a long time to exit.
Yeah.
So I think when then suddenly a lot of institutional investors, when they kind of compare the investment performance of managers in the US with that of Asian managers, they were saying, we're actually not getting that much more alpha by being in Asia, so why bother, right? So I think for fund of fund managers that have a very buyout focus, they suffered, right? So, but we have growth equity and venture capital, which performed phenomenally during this period. So we just have better returns to show.
Got it. So Edmond, are you able to talk through some of the investments that you made over the course of these, I suppose, the early years, and then even over the past decade?
Yeah. So this is the I have to be sensitive to what I say to our underlying investments, because sometimes when you mention some names and you don't mention others, then people get unhappy. But I think some of the we are fund of funds, so rather than talking about noteworthy deals, we should talk about some of the managers that that we backed. So I think I'm going to mention these three names because they're very well known, and and I think people cannot will not get jealous when I mention these names. I think the first one would be Capital Today, which is a growth equity fund based out of Shanghai. Right, started by a lady called Kathy Xu, who used to work at Baring Asia, and I think she decided to set up Capital Today because Baring was more focused on buyouts, and Kathy wanted to have the flexibility to do some venture investments as well. Capital Today they were the first institutional backer of JD.com. It became a very successful investment for them. So very proud to be associated with Capital Today. The other would be your good friend DCM. DCM have really backed a string of good Chinese e-commerce companies, right? I guess the latest major exit being Kuaishou, but they have also backed companies like VIP Shop earlier. So they have done well. And then another one is Gaorong Capital. So this is a fund set up by three gentlemen coming out from IDG Capital in China, and they are also, I guess, the Series A investor in Pinduoduo PDD.
Gotcha. Yeah, I mean, all these funds have performed extremely well, and their investors are highly reputable in China. And I guess part of understanding a fund and to the extent possible, the thought process, the decision making, behind the success that most of the media or the outside world sees is not just the winners, but also what are some of the harder decisions. So to the extent possible, are you able to share some of the, I guess, more difficult conversations internally, or what are some of the misses or things that you wish you had done differently?
Yeah, so this one is hard. I think I think conceptually we have always known, but in actual execution, it has always been hard, and I think it's hard for everyone, right? It's private equity is a relationship business, right? You do in-depth due diligence on a fund manager or on a company. You became very, very close to people that you invest in. So I think one of the most difficult decisions to make is when to cut off these relationships, right? And it's easier if the relationship just completely screw up, right? And they just did very poorly, and then it became it's easy to break off those relationships. But the worst would be people who in the past have actually made a lot of money for you, but they are
right.
But their performance, their recent performance, just aren't that impressive anymore. So we continue to struggle with this. It's basically when to cut off these relationships. Yeah. So yeah, we have to get better at that.
Yep. And does this vary by asset class or category? For example, based on my understanding, for venture, good investors are good investors, although there's different vintages and market trends and what's interesting tends to vary over a period of time. And it seems to me that private equity and some of the later stage investing could be a bit more consistent. I wonder what your view is on that. I mean, how might that dynamic affect what you described earlier on the difficulty of cutting off certain relationships?
Yeah, I think that's a good point. I mean, it's, of course, when we say performance, we look at both absolute performance and relative performance, right? So if it's just bad vintages, I think we could cut people some slack. Right? But the bigger question is if you keep missing those the best companies in each cycle, because there are these cycles, right? I mean, every now and then there's a new concept, and you need to make sure that you are in those in the best companies, because that's how you generate more deals, right? You especially in venture, it's like, usually the best companies also produce the best entrepreneurs, right? And then if you have that relationship, then you could back those the people coming up from these great organizations to set up their own.
That's right.
Back them early.
Yep.
So it's really important to have that. So yeah, we look at that. I think another problem is really another tough decision is just we're a big believer that fund sizes is an enemy to return. Fund size is an enemy to return. It's easier to manage a small fund. It becomes harder and harder as your fund size increase. So it's at what point do you think a fund is too big for the market? So I think that those are the toughest decisions. It's because the good managers, people chase after them, so they can increase their fund size, and then that's the hardest decision, right? It's just like, okay, when do you say that this is
Right.
too big a fund for them to manage?
Yeah, that's totally fair. I mean, when I look at the broader market, whether it's US or China, there's few funds that are super disciplined and repeatedly raised at the similar size. I suppose in the US, benchmark's a fairly good example. They only have like 5-6 GPs, been doing something comparable for many vintages. But then you have some of the larger funds, A16Z, and some other examples that really are getting larger and have more media presence, larger operating value addition type teams, and things like that. I mean, the VC business model itself is based on great investing and kind of picking out winners and a little bit of luck as well. But the business model itself is, like, at least to me, it's not necessarily the most scalable business model, right? It's not like a tech-driven business. It's still a bit more manual. I get what you mean by that dynamic, at least on the venture side. In terms of, because Axiom Asia also does growth equity and then private equity and buyouts. I was wondering, perhaps we could spend a bit more time on those categories as well. So you mentioned a couple of fund managers that you invested in China, the few that we mentioned earlier. What about some of the growth or buyout managers, whether in China or broader Asia, that you thought were very compelling that you can share about?
Growth equity. So when I was still at GIC, I think there was a very clear distinction between what growth equity, both growth equity deals and venture capital deals, right? Usually it's growth equity deals are just companies that have already shown profits. Venture capital, are investments in companies that are, not producing profit, sometimes not even revenues. So that's how distinction. But now the distinction, it's really blurring. Most of the growth equity deals that we see, are investments in companies that are still losing a lot of money. so it's actually more late stage venture rather than growth equity. So I think the dynamics is very similar to the VC market, right? And it's really about, but the difference between the VC fund managers and the growth equity fund managers is, I think by the time when the growth equity firms get involved in a particular space, the first round of competition was already over.
Yep.
This is a very different dynamics from, I think, from what you see in the US. It's usually there wouldn't be that many people competing in the same space in the US, but in China, it's once you have a good idea, it's not uncommon to see 30 competitors coming up. Right? I think the best example would be Groupon. Right. So Groupon in the US came up with this group purchasing ideas, right? And then the Chinese felt that was a good model, so they raised money, and then there were probably like 30 or 40, even 40 group buying companies in China. And ultimately Groupon itself didn't really do that well, and the group purchasing model, on a laptop, on a PC, just didn't really take off in China. Well, it took off, but it didn't really make people that much money, right? So the growth, but the growth capital guys, when they start looking at the group buying space, the first round of competition was already over. So they're really just looking at a handful of companies. So I guess it's about identifying which one is the best company and try to get into it. So it's very much about winning allocations.
Okay.
It's less so about, I would say there's some investment judgment as well, because at that time there would still be a few competitors in the space, but it's just a lot easier by that time to determine which one would be the ultimate winner. So it is, yeah. I feel it's very much about allocation, and that's why and it's not just the growth equity funds, the venture capital funds as well. They face the same issue, right?
Yep.
They're always fighting for allocation. From what I understand, you don't see that in the US as much. And because of that, the growth equity fund managers and the VC fund managers in China need to keep a much bigger team than their peers in the US. Because it's about staying current. It's about getting in front of the entrepreneurs, right? You hear stories about how managers in China, the partners, they will have to wait for the entrepreneurs in the hall, in the lift, in the elevator lobbies, and and just to get like 5-10 minutes of the entrepreneur's time, right? And then within that 5-10 minutes, they have to convince the entrepreneurs to work with them. So it's a different game. And growth equity in China is very much like that now as well. So for buyouts is it's a different market. I think it's you think about this, that's China, right? Growth equity and VCs are mainly China. But for buyouts, we talk about the mature economies in Asia. We talk about Australia, we talk about Japan, we talk about South Korea.
Okay.
And definitely competition level in these countries are not as intense as that in China.
Yep.
Right. You don't see that many new managers pop out, every year. But they have the same challenge. It doesn't require a lot of competition to start a bidding war. So because the buyout fund managers, they usually train investment bankers and management consultants, and I think they look at deals in a pretty similar way, and buyout, to a certain extent, is about the leverage. So as long as the manager is established in the market, they have equal access to good financings.
Yep.
So I think they're always just competing at the margin, right? Maybe one partner just know the space better than the other, which allows them to bid at a slightly higher price than the competition, and they get the deal. So for the buyout funds, it's you really just look at the network they have in their local market. So there are two markets as well. There's definitely the Pan-Asian buyout funds, and these are much bigger players. They look at bigger deals. So Axiom Asia, we stay away from that space, right? So we are looking for the smaller fund managers that play in the lower mid market, right? Because that's where the relationship matters, right? So I don't think you can find truly proprietary deals anymore. But that relationship still counts. So as long as manager is offering a fair value, for the business owner would do a deal with the person that they have a better relationship with.
Got it. So Edmond, as you talk through, well, I suppose early stage through private equity, through late stage private equity, there's importance of getting allocation to certain deals, like hot deals, good deals, you name it. And you also mentioned earlier during a conversation that GIC did some of the direct investments or co-investments, right? Even in the 1980s, 1990s, and early days. So for Axiom Asia, how important is allocation and co-investing with your GPs, and how do you go about doing that?
Yes. Yeah. So going back to, then we go back to Axiom investment strategy, right? So I mentioned to you that we are not an emerging market fund managers. We invest in both, emerging economies like China and India, and as well as mature economies like Australia and Japan. And then because of that, we invest in buyout funds, growth equity funds, and venture capital fund. But we still have this one problem, right? So the growth, I would say the buyout funds and the growth capital funds, they provide more stable returns for our investors, right? But still high enough, but stable returns. And the venture capital is where we can really get the outlier returns. But even with this setup, we have one problem, which is the longer J curve that fund of funds tend to have. Right? And by J curve, I mean the period of time when the fund would be marked in the negative return territories. Right. So co-investments and secondaries are very important in helping us mitigate that J curve.
Yep. So
right from the start, we told our managers that we would like to do co-investments with them, and the key is, when it comes to co-investments, again, it's different philosophy, right? So some of our peers, they are so active that they almost look like they are competitors to the GPs. We are very careful with this. We work with our GPs. We don't compete with them. So it's really just maintaining good relationship with them. I think the key is, I guess, it's reaction time. So in the beginning, GPs are always worried that if they showed the LP a deal, the LPs may not do it, and they couldn't close the deal because the LPs couldn't commit, right? So it takes time to build that, I guess, build up the confidence level of the GPs in Axiom Asia. But our experience is, you just need to react quickly, right? So they show you a deal, give them a yes or no answer as soon as possible. Right. So you just don't drag them on.
I see. Is this typically a case where the GP does not have enough capital, or like, let's say like they exercise their pro rata rights, they don't have a ton of capital left, they need some more capital, they like to offer that to the GP? Or is it more of a case where they have a good deal, they can invest in it, but want to create some value for the LPs? What does that dynamic look like between the two sides?
Yeah, so I would say usually it's the deal is too big for them.
Okay.
Yep. So in the buyout cases, you may have fund managers that only have $500 million. They're trying to do $100 million deal. Right. So that's the opportunity for us. And then I think you also you're right on I guess some of the venture investments and growth investments is if the GP doesn't have the money to take up their pro rata portion in the later rounds, then why not give it to the LPs?
Yep, that makes sense. I mean, there's a decent synergy there. Okay, good. Well, it's really helpful to kind of get that perspective, and I feel we essentially mapped out to an extent Axiom's approach to Asia, right? Some of the buyouts in the mature markets, and then it seems like China has a steady dose of venture and growth equity. And we talked through some of the secondaries and co-investments as well. I think for the last period of our conversation, we can kind of bring the focus back to China. You do spend a lot of time there, and I believe you're heading back there later this month, right, from Taiwan?
Yes.
Okay, that should be exciting. A lot of stuff happening there. It's basically back to normal. So you have a very, from a fund of fund perspective, you have both a detailed but also a high level broad perspective on what's going on in the market.
Could you share a bit more about what you're seeing? What are some of the categories or trends that you're particularly excited about and talking to your GPs about?
Unfortunately, I don't think I can surprise you with any great insights here.
Okay.
Yeah, I think most of our fund managers are still looking, at companies in just the well-known high growth sectors like B2C e-commerce, B2B business services, social media, social commerce, healthcare services, biotech. I think those are still the hot areas. We are in the midst of a technology war between US and China, and that has, and then I guess the space that is most talked about is semiconductor. So I think China is very keen to build up its semiconductor industry. So I think there will be a lot of government investments in the space. And I think we're just talking to most of our fund managers, even the ones that traditionally had not looked into hardware. They are looking at semiconductor companies now. But I think this space is going to be much more difficult, right? And in a sense, semiconductor is kind of like biotech. You don't really have proof until you put the product in the market.
Yeah.
So I think some firms will pay, significant tuition fees. Ultimately, I think it should still be an attractive sector, but we have to be careful with who we want to back in this space.
Yeah. Some of those companies have extremely high valuations, both in the private market, but also when they go public. It seems that I don't know, what is a PE for some of these companies on a Chinese exchange, like 100x.
Yes.
And it seems like the government is very supportive of these developments as a point of national security. And it kind of feels like thus far it's been a sign that, hey, we want you guys to build real technology-driven companies. Want you to list it, oftentimes in China these days, and we want you to be rich. But it needs to be real tech-driven companies. And a lot of kind of companies with good tech or tech that enables tend to benefit from that. And I want to get your perspective on that piece as well around the Chinese stock exchanges, because it seems to me that there's been a lot more financial liberalization in China. There's the so-called star market in Shanghai, and then there's another one in I think Shenzhen, and many more companies that probably previously would have tried to go public overseas are going public within China. This is not even Hong Kong. This is actually within China. It's like Segway Ninebot being one example of a company that had a VIE structure, but was one of the first to issue these CDRs in China. I was wondering, how much do you think about that, and how might that impact some of your work at Axiom Asia?
Yeah, we welcome the development, right? For us, it's just additional exit venues for our investments. So the more vibrant the domestic markets become, the better it is for us. Yeah, but but of course, listing in China comes with other risks. Yeah, that it's not as definitely you get very high valuations, but there are also a lot of restrictions when it comes to selling your shares. Right, so you can only sell at a very slow pace, especially if you're deemed to be a influential shareholders, which I think some of our managers would be considered as such. so yeah, I think they're always weighing the costs and benefits of going for local listings, and that high valuation, they don't really stay. Right, we have seen since the reopening of the Asia market for IPOs, was that from 2009 or so, it's, you always have this initial pop where companies trade at more than 100 times earnings, right? Then 3 years after that, it actually goes to a more earthly multiple. So and if you're not in a hot sector at the time, the valuation can actually get to really low level. It's even lower than what you see in Hong Kong. So I think I think we need to be careful and don't be too attracted by just high valuation at the moment. It's tough though. It's really, really tough. I think entrepreneurs are very attracted by these valuations. So our managers always, I think most of our managers, because we invest in US dollar funds, right? They still prefer to take their company public overseas, right? If not the US, Hong Kong.
Right. Right.
Yeah, but definitely it's definitely a positive development for us, and it's a great development for renminbi fund managers, right? Because they were investing in companies that were prepared to go IPO on the domestic market, and and they probably made these investments when at valuations that are much lower, because they don't face the competition from the US dollar funds. And now there's this exit channel, so they are really they're really doing well.
Right. Certainly, yeah. Well, I mean, it does take experienced long-term investors to really navigate a lot of these developments. I mean, some of this seems to be structural and have long-term kind of payoff, but sometimes there's these hype cycles. I think it's not just limited to like 100x PE for a semiconductor company on a Chinese starboard, but look, some of the SPACs that are going on, or you look at crypto space, even less stable, right? Like the so-called NFT opportunities or market is white hot right now, and I mean, actually that might be a topic for another day. It's actually quite fascinating, and some of the I guess the elements of what it offers is creating real value today. But back to your previous point, like these type of things happen all the time, but it really takes a disciplined investment approach to manage it well. So wish you and team best of luck with your continued success. Maybe one last quick question, Edmond, if you have time, is going back to you and going back to Axiom Asia. What is you raised quite a large vehicle recently over the past quarter or two. It seems like you're growing your team quite well. What are you looking ahead to? What are you excited about? What are you looking forward to over the next period?
Yeah, I think we are still just at the beginning of the Asia private equity boom. Right. So I think the best has yet to come. Yeah, I think one of the, I wouldn't say I would look forward to it, but I think some of the things that will definitely happen is Asian investors would become a bigger driver of fundraising in the Asian PE market. I think right now, unless you're talking about the renminbi fund universe and also South Korea, most of the private equity money comes from the West, and we are seeing emergence of Asian institutional investors, but they are, at this point, they're still more interested in growing the exposure to the US and Europe, mainly because diversification, because they're already in Asia, and they feel like they should build the exposure overseas rather than staying in the home market.
Right.
But I think Asia is still where the growth is, right, for years to come. So if the returns here stay robust, I think a lot of this Asian institutional money will come back, and I think the market will be better for it.
Okay.
We're still very excited about China. To me, trade war, tech war aside, I think China will just continue to grow and get stronger. And at some point, I just hope the world will realize that the strength of the Chinese economy does not come from its government. It's really from the desire of the Chinese people. They want to improve their quality of living, and it's just poor people trying to get rich.
I totally get where you're coming from with that perspective, having spent some time in China, and also to a broader extent, some time in Southeast Asia, visit Vietnam, Thailand, Indonesia, some of these other regions. I think, yes, a lot of these Asian markets, people there don't have a great standard of living yet. I mean, some do, some don't, but they work very, very hard. This is especially the case in China, and I would say Vietnam as well. So, it's very inspiring, and look forward to a world where there's more exchange between folks in all these different nations, get to perhaps spend some time in another country and kind of walk in their shoes for a period as well. I think they have a much better perspective.
Yes, totally agree with that.
Yep. Okay, Edmond. Well, thanks so much for your time today. Really fascinating perspective on your investment experience on GIC, on Axiom Asia, and also what's happening in the market. So I'd love to be in touch, and maybe we'll see you again in the future.
Yep. Thank you very much, Adam. Nice talking to you.
No worries. You as well. Take care.